So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift, is, oh wow, if I can find a bit more cash, I can put it into the market, and you tend to do really well over the cycle by doing that strategy.
Raoul Pal begins by addressing a fundamental aspect of investing in the crypto asset class, volatility. He emphasizes that significant drawdowns, such as the recent 27% dip in Bitcoin, are not only expected but also within the range of normality for this market. According to Pal, understanding the business cycle is crucial for investors. He explains that the current economic environment, characterized by declining inflation, falling interest rates, and increasing liquidity, is typically favorable for cryptocurrencies. This, coupled with the ongoing technological adoption in the crypto space, forms a strong tailwind for the market. Pal goes on to discuss the market's response to recent macroeconomic events, particularly the role of currency movements, like the yen, in triggering risk-off scenarios. The intervention of the Bank of Japan in the currency market, which led to a sharp appreciation of the yen, forced many investors to reduce their risk exposure. This broad de-risking affected not just cryptocurrencies but also other asset classes, including tech stocks and commodities. However, Pal reassures that these macro spasms are typically short-lived, as markets eventually adjust to the new reality. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
When you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get 2, 3, or even 4 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is, the main drivers of crypto are the business cycle, i.e. where are we with the economy? Well, we're starting to pick up slowly, inflation's coming down, rates are going to come down, liquidity is going to come in, and so therefore that's usually a very good time for crypto. So the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift, is, oh wow, if I can find a bit more cash, I can put it into the market, and you tend to do really well over the cycle by doing that strategy. It's generally not the change of interest rates. Nobody really cares if your rate goes from 10 basis points to 25 basis points or whatever, right? What it actually was the move in the yen, because you have to pay back, you're borrowing yen. When the yen starts moving a lot, then that starts concerning you. The yen went up a lot, so suddenly the amount of yen you've borrowed has gone up in dollar terms. So what happens is everybody reduces risk. And that was the real thing, is the Bank of Japan started intervening in the currency market because their currency was too weak, and they started selling dollars and buying their own currency. That's what everybody borrowing yen went, oh my God, now suddenly, yes, I'm getting a cheap pickup in borrow, but bloody dollar yen is moving 2% a day every single day, and I'm losing a lot of money. And what happens is a risk manager comes along at a bank or a hedge fund and goes, you need to close your positions or reduce your risk. And that's really what the last 4 days were all about, was the risk manager tapping somebody on the shoulder saying, listen, you're losing money on this side, you need to start reducing risk. And that's why everything gets hit, from crypto to NASDAQ to mining stocks to oil to anything, any risk at all. But these tend to be very short-lived because, once the market resettles, they get used to the change, people have been washed out of positions, it then kind of settles back to normalcy. And these, I call them macro spasms, they don't usually last very long. Could it last a week? Could it last 2 or 3? That's possible. 2016 saw very similar. The dollar had been very high. The world economy was super slow. World trade had slowed down because the dollar was so strong. And the Japanese came in and intervened in their currency. All the markets blew up. Exactly the same mechanism. But what happened after that was the central bank started stimulating, particularly the Chinese, because they'd been waiting for this moment to do so. The Europeans last time around and the UK last time around. This time, I think it's going to be the Chinese who are going to stimulate. And why they get to stimulate is they couldn't do much cutting of interest rates or stimulating of monetary policy because their currency was too weak and they didn't want to lose control of it. But now the dollar has weakened, they're able to do more. So I think really it's probably a net positive. Just give it a few weeks and it's probably very positive. So firstly, it depends when these events happen. If the economy is rolling over after you've had a strong period, inflation has been rising, the Fed are raising rates. If it happens then, it can risk turning into something bigger. When you're the opposite, which is the business cycle is just turning up now, the Fed are cutting rates, the probability of this being a bigger event is significantly lower. So from that probability, less so. The other thing is something happened in 2008 that has stopped a lot of this. In 2008, the central banks discovered the money printer. And the money printer, and you and I have talked about it on this show before, essentially is debasing the currency by printing more currency. Now, it's dressed up in a nice term called liquidity these days. It used to be quantitative easing, but they find different ways of doing it. When they print more currency, it makes the value of the purchasing power of that currency go down versus scarce assets. So it makes assets go up. So now every 4 years, in fact, that we've come close to something that could be nastier, they've started printing money. And it's not just the US, it's everybody, all the main central banks. And that has kept a bottom under markets. Even in 2022 was a bit trickier because we had inflation. So it was hard to print money. But eventually when it got to it, when the S&P was down about 30%, they kind of went enough's enough. And they started printing money again. So I don't think there is a lot to fear. In fact, I would be so outrageous to claim the probability of a down 50% market is now miles smaller than it was when you and I grew up, when it was a common occurrence that we would see it. We won't see this again because of the money printer.
Okay.
Doesn't mean it's a risk-free world, obviously, because when they print money, they're debasing your savings by 8% a year to start with. But if you think of that 8% cost of that debasement, that's like the central bank's buying a put option on the whole system, and it's costing you 8% premium a year. Put it that way, it's not the worst thing in the world, but it's never great.
Pal explains that while currency debasement may prevent catastrophic market downturns, it also imposes a hidden tax on savers by reducing the real value of their money. This phenomenon, according to Pal, is why assets like Bitcoin, which have historically outperformed traditional assets like the S&P 500 and NASDAQ, are becoming increasingly attractive. Bitcoin's remarkable returns, driven by its scarcity and adoption as a store of value, make it a powerful hedge against the ongoing erosion of purchasing power. Pal suggests that the future of monetary policy will be heavily influenced by the need to manage massive national debts. He predicts that central banks, particularly the Federal Reserve, will be motivated to lower interest rates to make debt servicing more manageable. This environment of low interest rates and high liquidity will continue to support asset prices, including cryptocurrencies, which benefit from the relative weakening of fiat currencies.
It's a trusted source of truth.
Yep.
Now, it's not exactly the same measure as Fed inflation, but it's currently at about 1.5%. Now, inflation itself is driven by a lot of lagging factors, and housing is the big lagging factor, and wages, both of which are coming down. So we should see inflation much lower. Now, if I look at something called inflation break-evens, that's Wall Street's guess of where inflation will be in 1 year's time. If I look at it now on my Bloomberg screen, it's at 0.63%. So they're pricing in a massive undershoot of inflation. So it's telling us that rates should come down significantly. Right now, they're probably 100, 150 basis points too tight. And I think they should come down to probably around 2%, which is also very convenient because this year, the US Treasury has to roll $10 trillion of debts. And it's very expensive to roll it at 5.5%. It's a lot easier to do at 2%. So, I think it's a blessing, and the Fed will want to get rates as far down as possible for the next kind of 12 months when they have to roll all of this debt. It's like nobody wants to refi their mortgage at 5.5%. They want to refi it at 2%. It's exactly the same mechanism for the government because it costs you a lot. If you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The Nasdaq's done about 17%, but Bitcoin's been doing 150%. And when you look at Nasdaq versus Bitcoin, the Nasdaq is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right, we're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power. So the volumes in ETFs are driven by two: net inflows, or people known as arbitrageurs who are arbitraging the futures market. So we don't know what that flow was. So they would sell the futures, which trade at a premium, and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the NASDAQ over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity.
Pal also touches on the evolving sentiment among investors, who are becoming more educated about the crypto market. He credits this shift to the collective efforts of industry leaders and educators who have highlighted the long-term benefits of investing in cryptocurrencies, despite their inherent volatility. This growing awareness is reflected in the increasing inflows into crypto assets, even during market sell-offs, as investors start to recognize these dips as buying opportunities. Raoul Pal's insights offer a balanced perspective on the current state of the crypto market and the broader economy. While volatility is an inherent part of investing in this space, understanding the macroeconomic backdrop and the actions of central banks can provide investors with a strategic advantage. As Pal suggests, embracing the volatility and using it to compound returns over time is a strategy that has proven successful for many seasoned investors. Please like and subscribe my channel.